Kia ora, and welcome to a chorus. I'm Bernard Hickey for The Kaka. This is a video and podcast I do for paying subscribers about Aotearoa's political economy around housing, climate and poverty. Regular listeners and watchers will know that I have a view of the political economy that's very focused on housing, house prices, housing affordability, unaffordability, the way that housing is right at the core of families' views of investment and saving rather than as a place to live, and the distortions that's created in not just our economy but in our politics. Today I wanted to talk about some things that the Prime Minister, Christopher Luxon, has said about house prices, and some things that Chris Bishop has said about house prices in the last few days, and what respectively they're doing about it. So we know, of course, that housing is brutally unaffordable for those people who have regular incomes and haven't got support from their parents with deposits and the likes. We know this has been the case for a good 15 to 20 years, and it means that house prices relative to incomes have risen from around about 3 to 4 times. So a house would cost 3 to 4 times a household income way back in the early 2000s to as high as 11 to 14 times income right at the end of 2022. Now that has improved a bit over the last 3 to 4 years because of the fall in house prices and because incomes have kept rising over that time. But they're still around 6 to 9 times income, depending on where you are in the country. And obviously places like Auckland or, heaven forbid, Queenstown have house price to income multiples around 3 to 4 times higher than they were back in the early 2000s. Now, the general view amongst housing analysts is that an affordable house price is one that is around about 3 to 4 times income. So if you were to see housing become affordable again to buy, and there's not a bad correlation there between housing that's very expensive to buy and housing that becomes increasingly expensive to rent, then you'd need to see house prices basically halve. And if it was going to happen quickly, they'd have to halve overnight. Yet that's not what you hear from politicians from all sides of Parliament, or at least the ones who stay in Parliament. And I wanted to show you some things that have been said and things that have happened over the last 20 or 30 years in our political economy around housing. So let's go first to what Christopher Luxon and Chris Bishop have been saying. Yesterday, speaking to Corrandan on RNZ, Christopher Luxon was asked whether he thought it was a good thing that house prices were falling or had fallen, and asked specifically about some things that Chris Bishop said last Friday on Radio New Zealand's Morning Report. The interview was the same, Corrandan. Now, last Friday, Chris Bishop was asked, did he think house prices falling was a good thing? And he said it was. And that the government's overall view was that in the medium to long term, it wanted to see house prices and rents more affordable, much more affordable, and lower. And he has said in the past, Chris Bishop, that he wants to see house prices relative to incomes back down around that 3 to 5 times level. So we have seen house prices actually fall in the last 3 to 4 months, another 2 to 3%. And it's clear now that there's a bunch of rental property investors and homeowners getting a little bit nervous about the things that they've believed as always true forever, which is that house prices over the long run always rise, and they rise faster than incomes, and that there is a tax-free capital gain on that, particularly if it's leveraged, that you can use to save for your retirement. And getting on the ladder is a Kiwi birthright. that everyone should have a chance to do. Now, those who are realistic about these things after the house price inflation of the last 3 decades knows that that's impossible now, unless you've got a significantly higher income than normal, or have had help from parents in the form of deposits, or rent-free accommodation and subsidies for food and education and the likes. And but politicians of all sides have persisted with what I call magical thinking, where they say, we can have it all. We can have rising house prices, or at least not falling house prices, and we can have affordable housing. We just need to wait a while. And it's worth challenging that magical thinking, that we can have it all, because Christopher Luxon is saying, I agree with Chris, we do need affordable housing, but the way to achieve it is to have incomes rise faster than house prices, and that there would be modest, consistent rises in house prices. Sort of weird to think that a politician who is in favour of free markets thinks that prices of assets should rise in a consistent, modest way. Asset prices don't do that unless you control them. And it's worth challenging this idea that we can have modest, consistent price rises and affordable housing. Chris Bishop is more realistic on this. He knows that to achieve this anytime soon, and his current view is that it should be in the next 20 years, there will have to be house price falls and rent falls. But the problem for him and his party and politicians on both sides of Parliament is that we have a housing market with bits tacked on, not just for our economy, but for our politics. And you can see this over time. The affordability metrics, so that's the mortgage servicing costs. So this is aside from incomes, because you can argue that, house prices are naturally going to be have a much higher multiple to incomes because interest rates are lower. And some people argue, well, there's many more people working now, and therefore that's why we can actually afford it. And this is a measure the Reserve Bank's done, looking at the mortgage servicing costs as a share of income. So once you get to about 50%, it becomes pretty hard. It got to there in 2007-8. It actually improved right through to COVID, and it got down to 35. Of course, this again assumes you've got money for the deposit. And then during COVID, it exploded again. There is another measure you can use. So what's the relative costs of servicing a mortgage compared with renting? So the theory is, of course, if you've got the deposit again and you can afford all the other costs of home ownership, insurance rates, that sort of thing, that if it gets cheaper relative to renting, then maybe you can afford it. But basically, even now, we're talking about a 30 to 40% improvement in affordability, just looking at those types of metrics, let alone house price to income multiples. And you can see here that Chris Bishop wants to get to a house price to income multiple of 3 to 5 over the next 20 years. To do that, our wages would have to rise 3.6%, so 3.5% faster than house prices for 20 years to get there. That's quite hard, given house wage inflation has been around 2 to 3% for the last 20 or 30 years on average. So that would imply that for the next 20 years, house prices would have to go nowhere, and that wages would have to continue growing at 3.5%. However, we've got a disconnect here. Businesses actually expect wage inflation of 2% over the longer run. Households seem to think they're going to have income growth of 4.9%. Now, it is possible to have income growth that is faster than wage inflation if you have more people working per household and they work for longer, but that's not what we've been seeing in recent years, as fewer people find work and they also work fewer hours. And at the same time, homeowners, according to the surveys we have from the Reserve Bank and from ASB and ANZ, homeowners think that what's normal is house price of inflation of about 6% per annum. So depending on your view on wages, and house prices. There's a serious disconnect there. Somehow people think this can continue. You'd need a few things to happen to be able to make that continue, which is why governments get nervous about house price falls. You can see this as a chart, thanks to musical chairs, showing house prices in real terms. You can argue that voters, consumers don't really understand real inflation or deflation, i.e. adjusted for inflation, but I suspect they do. And it's remarkably consistent that when real house prices fall, governments get kicked out. And we certainly saw that in 2023. We saw it in 2008. And you could argue we saw it in 2017 as well. And you then ask the question, if house prices are falling now and Christopher Luxon wants to get re-elected next year, what's he going to do to turn around house price inflation? What could he do? Well, one way to do it is to get the official cash rate down. It turns out that Christopher Luxon is now regularly meeting with the acting governor of the Reserve Bank, Christian Hawkesby, before Reserve Bank interest rate decisions. Now, this is a common practice for finance ministers to do, just as sort of a heads up, we're going to tell you what we're going to do tomorrow before we do it. But usually these discussions are kept to a bare minimum. And there is a convention, at least, that politicians who are in power don't like to say things like, we think the Reserve Bank should cut the interest rate or increase the interest rate or whatever. Well, yesterday, Christopher Luxon was asked by Mike Hosking if he agreed that the Reserve Bank had been too slow in cutting interest rates. And Christopher Luxon said yes. He said he had a few reckons and that he'd told Christian Hawkesby this, that he thought they'd been too slow when they met before the decision last week. Now, the decision last week turned out to be much more dovish, i.e. more rate cutty than the markets expected, and that surprised everyone. And you can see here that the Reserve Bank basically cut about 30 basis points off its forecast track for the official cash rate. But interestingly, even now, the Reserve Bank sees interest rates starting to rise next year. So that might be difficult if you wanted to get elected and you wanted house prices to be rising again. So what else can you do? Well, one thing you can do is get banks to lend more aggressively, pump more credit into the market. And what you see here is the Reserve Bank chart showing credit, i.e. lending debt by sector as a percentage of GDP. So this takes into account income growth and is a pretty good measure in relative terms. Now, if you look closely at the axes for this chart, you can see that housing debt has risen. It's the right-hand side. Housing debt has risen over the last 25 years from around about 50% of GDP, 55% of GDP, to as high as 92, 93% of GDP at the peak of COVID lending. It's come off a bit since then, but basically just under 90% of GDP. Now, what's interesting about this is that since COVID, there's been a significant drop-off in lending to business and agriculture relative to GDP. So what we've seen is basically a very slight increase in housing debt relative to GDP between the beginning of COVID and now. But we've seen a fall in housing debt for business from around about 38% of GDP to about 32% of GDP, and it's steeper even for farm lending, down from 20% of GDP down to about 15% of GDP. So what that means is that since COVID, our banks basically have been not lending to businesses and farmers and lending more to households. So that's one way to do it. And yesterday the Reserve Bank loosened its credit, or proposed looser bank capital requirements for banks, which would mean that they have overall, over the next 2 to 3 years, $7 billion more spare capital to base lending on. because of those changes. And now, if that was all applied to mortgage lending, you could pump an extra 190 billion or so into the economy. Or you could just save it and send it back to Australia as an increase in profits and dividends. And that would be interesting to watch. Well, you could bump up migration. That could help house prices. The Reserve Bank does see a bounce in migration coming, and we've certainly seen announcements from the Immigration Minister, Erica Stanford, to try and loosen migration settings to get more people coming in. We'll see whether that works. Less house building? Well, that's certainly been the case in the last 18 months, and the government actually stopped Kāinga Ora building new houses over the next few years, more than 3,500. Remember, Kāinga Ora was the biggest source of demand for new housing. And you can see we're getting our dwelling consents per 1,000 people measure well down to where it was in the long run over the last 25 years. So around 4 to 8 per 1,000. Briefly, post-quake, Canterbury got up to 16. Briefly, Auckland, after the unitary plan changes, which allowed people to build more houses in Auckland, briefly got up to 16. But we're headed back down towards that 4 to 8 mark at the moment. So that's one way to do it. I just wanted to put these pictures up. They're from an article that Stuff and TVNZ have done in the last couple of weeks about a car park in Christchurch, which has become a place for homeless people to stay in vans and camper vans and old buses and tents. It's wet, it's cold, freezing at night. And one of the residents at that car park is there on the right, draped in blankets because it's too cold. Now, the council wanted to shut down this car park / temporary housing place that was in the car park of a church. Last night, they relented on that briefly, but this is the guts of where we are. We have unaffordable housing, not enough housing, awful homelessness, and yet our Prime Minister is talking about modest and consistent growth in house prices and housing affordability at the same time. It's performative. It's magical thinking. It is awful. I'm Bernard Hickey. That was a chorus for Tuesday, August the 26th on the Kaka. Ka kite anō.